In this video, you'll learn how accountants complete step 7 of the 9-step accounting cycle by posting closing entries to the general ledger. In the prior video, which I linked above, we learned about the 4 steps of the closing process for a manual accounting system and how accountants record them in the general journal. This process is automated for companies that use accounting software. Sometimes that automated process is as easy as the click of a button, close the period. It can also be quite complicated if the company is a multinational business that operates with different legal entities in different countries and time zones. Also, just because something is automated doesn't mean mistakes can't happen. An issue I experienced during the closing process was that a new general ledger asset account was set up incorrectly as an income statement account and mistakenly closed during the closing process. In accounting, there are a lot of opportunities to do things incorrectly. That is why there are so many checks and balances. Before we get to the process of posting, just a couple additional reminders. First, the closing process is a sort of reset button for temporary accounts, such as income statement, as well as the drawing and dividend accounts. The reason for closing these temporary accounts is that we want to be able to look at the results for a specific accounting period without it being muddied up by other time periods. The 4 steps of the closing process consist of 1, closing revenue accounts to income summary, 2, closing expense accounts to income summary, 3, closing income summary to capital, and 4, closing the drawing account to capital. Here we have the closing entries for Eli's Consulting, where we followed this process and recorded these closing entries in the general journal. The next step is to post the journal entries to make the journal entries part of the permanent accounting record, the general ledger. Posting in a computerized accounting environment occurs when the accountant uploads the journal entry into the accounting system or keys it in. And the approver of the journal entry reviews and clicks approve. Large companies may require multiple levels of approvals, and sometimes it can take hours and even a couple of days before everyone who needs to review and approve the journal entry has done so. This level of approval is typically reserved for a very material and impactful transaction. However, I've also seen a process where every division that was impacted by an accounting allocation had to sign off on it, which can be painfully long. Accountants are often chasing down where in the approval process the journal entry is. Once it is approved, though, the system will automatically post it. The reason that you're learning how to manually post the closing entries to the general ledger is so that you know what the accounting system should be doing. You will likely be involved in the user testing process when new systems or system updates are implemented. In that case, you will perform end-to-end testing that systems are still functioning as expected. And as I already mentioned, just because something is automated doesn't mean nothing can go wrong. We'll start with our first closing journal entry in which we're closing the temporary account fees income of $47,000 to income summary. For the posting process, we'll look at the account fees income first and write the date in the date column, the word closing into the description column, the post ref J4, which by the way refers to the journal page number 4, into the posting reference column, and $47,000 into the debit column. We now need to calculate the new balance in this account, which is 0. Next, we need to post the credit side of our journal entry, which we'll record in the account income summary. We'll write the date into the date column, the word closing into the description column, the post ref J4 into the posting reference column, and $47,000 into the credit column, and calculate the new balance in this account, which is $47,000. For our second closing entry, in which we closed all expense accounts for a total of $13,333, the income summary, we'll start with the account income summary first. Write the date into the date column, the word closing into the description column, the post ref J4 into the posting reference column, and $13,333 into the debit column. The new balance is $33,667. This amount serves as the first double check that you closed all income statement accounts. The balance in this account should be equal to the profit on the worksheet income statement. The second double check is when we prepare a post-closing trial balance later in this video. Next, we need to post the credit side of our journal entry, which we'll first record in the account salaries expense. Write the date, the word closing, the post ref J4, and $8,000 into the credit column. The new balance is $0. We now need to record the remainder of the credits in the next account as utilities expense. Write the date and the word closing, the post ref J4, and $650 into the credit column. We now need to calculate the new balance in this account, which is 0. The next account is supplies expense. We'll write the date, the word closing, the post ref J4, and $500 into the credit column. The new balance is $0. The next account is rent expense. Write the date in the date column, the word closing into the description column, the post ref J4 into the posting reference column, and $4,000 into the credit column. We now need to calculate the new balance in this account, which is 0. The last account is depreciation expense. We'll write the date, the word closing, the post ref J4, and $183 into the credit column. The new balance is $0. I'll now move on to our third closing entry, in which we closed income summary to Trayton Eli Capital. Let's look at the account income summary first. Write the date into the date column, the word closing into the description column, the post ref J4 into the posting reference column, and $33,667 into the debit column. We now calculate the new balance in this account, which is 0. Next, we need to post the credit side of our journal entry to Trayton Eli Capital. Write the date into the date column, the word closing into the description column, the post ref J4 into the posting reference column, and $33,667 into the credit column. We now calculate the new balance in this account, which is $133,667. We'll now look at our fourth closing entry, in which we close the drawing account to Trayton Eli Capital. Let's look at the account Trayton Eli Capital first. And as we've done before, enter the date, the word closing, the post ref J4, and then the amount of $5,000 into the debit column. The new balance in this account is $128,667. Next, we need to post the credit side of our journal entry to Trayton Eli Drawing. Write the date, the word closing, the post ref J4, and $5,000 into the credit column. The new balance is 0. This last posting completes step 7 of the 9-step accounting cycle, and we're ready for the post-closing trial balance. The 8th step in the 9-step accounting cycle is the post-closing trial balance. It contains only the permanent accounts which were not closed at the end of the period when we posted our closing journal entries for the temporary accounts. We prepare this post-closing trial balance to prove out that our trial balance still balances and that all revenue, expense, and drawing accounts have a 0 balance. It might seem like an unnecessary step, but you have probably come to realize how easy it is to make a mistake. Accounting is all about checks and balances. So this is just an extra checkpoint to ensure that we're still balancing, that all temporary accounts have a zero balance. If the post-closing trial balance does not balance, the accounting records contain errors. That means you will have to find the last point where your trial balance balanced and work forward to identify where you made an error. If you're asking yourself why you're learning this manual accounting process when this process is automated in most companies, here's the answer. First, you're learning the basics of accounting and will need to be able to understand what an accounting system is supposed to do. With that, let's get into what the post-closing trial balance looks like. This is the post-closing trial balance for Eli's Consulting Services, which is shown on the first line of the header section. The second line contains the title post-closing trial balance, and the third header line contains the date December 31st. Next, we list all of the asset accounts and their balances in the appropriate column. And remember that accumulated depreciation is a contra asset account with a credit balance. Next, list all of the liability accounts, followed by the capital account. We then add up all of the debits and the credits, and both should equal. If your total debits do not equal your total credits, first calculate the variance, meaning the difference between the total debits and the total credits. Does that amount seem familiar? Did you forget to list one of the balance sheet accounts? If that's not the case, divide the amount by 2 because perhaps you entered the amount on the wrong side, meaning a debit as a credit. If that's not the case either, divide the difference by 9 to check if you transposed a number, meaning you entered 540 instead of 450. If you still can't find it, go back to the last trial balance, set balance, and double check each account that you listed in the post-closing trial balance. With time, you will develop a sixth sense for where you made a mistake. A good approach is to work slowly and double check your work along the way. This way, you won't have to spend a ton of time finding your errors. I hope this video helped you learn the process of posting a journal entry to the permanent accounting record, the general ledger, and understand how accountants use the post-closing trial balance as a double check that all temporary accounts are closed.